Nice. Okay, so let's welcome Melissa Bustarde.
Thank you, Ruvain, and good morning, everyone. My name is Melissa Bustarde. I am a transactional business attorney. I'm based in San Diego County, licensed in California, and I work generally with small businesses as their outside general counsel. And so the Corporate Transparency Act hits my client base pretty hard. So I was forced to get up to speed on it earlier this year as it got enacted. I've done this presentation a couple of times, although all my prior presentations have been targeted to attorneys. So I apologize if some of it seems a little bit technical. But it sounds like there's a good mix of you out there that are professionals advising clients, as well as people that are working for the business themselves and advising the business directly. So I'll try to attack it from both standpoints as we go through the presentation. But I've learned the nuances of the act, and I've done the filings throughout the year, and certainly through the growing pains with the BOI filing. So let's jump into this and learn a little bit more about what the federal government has blessed us with the Corporate Transparency Act. So a little bit of background is this act was enacted back in 2021 by Congress, but it went into effect on January 1 of this year. And the concept or rationale behind it was that there's bad guys out there that use these, small, easily created entities and use them for bad things like tax fraud, money laundering, and financing terrorism. And the feds want to dig down to figure out, well, who's really behind these entities so they can figure out how to get to them. So to make it harder for them to hide behind shell companies. The bad news is that a lot of people that form entities are really good guys and don't have anything to hide and don't do anything bad, but we're stuck complying with this law as well. And the irony of this, as I'm sure you all appreciate, is that the good guys are the ones that are actually filing because we want to avoid the penalties, and the bad guys probably aren't even filing anyway. So this law applies to business entities, and we're going to kind of dive deep into this in just a second. But for the business entities that fall under the law, you have to report information on the beneficial owners, which are the individuals that are ultimately in control of the company, which includes both ownership control as well as decision-making control. These reports are filed with the Financial Crimes Enforcement Network, also known as FinCEN, which is a part of the U.S. Department of Treasury. We've included the link on there where you can actually go and file online. So in terms of timing, if your company was created, so it was filed its articles or its organizational document with the applicable Secretary of State or state body before January 1 of this year, then they have till the end of this year to report. So for all of you that are working with working in or working with businesses that are already existing before this year, you have until the end of the year. So, a couple months. We're now in Q4, if you could believe that. You have a couple of months left, but not a super big time crunch. For new entities that are created this year, in 2024, you have 90 days to file your initial report. And for new entities that are created starting January 1 of 2025, you have 30 days to file the initial report. And then there's also a requirement that we'll get into later on if there's any changes or updates to your filing, those all have to be done within 30 days within the change. So knowing that, there's a lot of personal information that's going to go into these filings that wasn't previously required or disclosed. Certainly in California, we were never required to disclose ownership level to the state government outside of tax returns. So everyone's curious, well, okay, we're going to file with FinCEN, but who's going to have access to all this information? And to be honest, it's a little vague. This spreadsheet's a little bit out of date. So current, was created back in the spring, was a handful of federal agency users, whoever that may be. The summer of this year, it was supposed to be expanded to Treasury officers and other federal agencies that are engaged in law enforcement and national security activities. This fall sometime, they were supposed to expand it to more federal agencies, including law enforcement, national security, intelligence, and state and local law enforcement agencies. Later this winter, they're planning on expanding it to intermediary federal agencies in connection with foreign government requests. Now, those are supposed to be limited to law enforcement investigations and national security and intelligence issues. Next year, they are planning on expanding it to allow disclosure of the information to financial institutions that have customer due diligence requirements. Are they going to expand it more? Who knows? That's really up in the air. And as you can see from these different categories, it's pretty broad and it's pretty vague as to who's going to have access to this. Now, as of this point, it's not a publicly available filing. So there's no way to search on their website to see who's filed and what the filing consists of. So it's a little bit different than you might see with some state filings that you do on the state level, where you're reporting your, generally your annual report, where you might identify your corporate information, your officers, directors, and those are generally available for public. As of now, these are not available to the general public. You can't search for it, and so someone off the street can't go and look this stuff up. And the bad news is that you also can't figure out if someone in your organization has filed already that you're unaware of it. That actually happened to me with one of my clients. He said, here's all information, go file. I went and filed, categorized it as an initial report. And I went through the whole filing. And at the end, the filing was rejected because an initial report had already been filed for that entity. So that'll be a hard lesson learned. So you definitely want to make sure that, you're talking to everyone within your organization and you have clear direction as to who's in charge of filing, so you don't duplicate the work and waste time. So who does this apply to? It applies to what they call in the law reporting companies. So a reporting company is any entity that's created by filing a document with the Secretary of State or a similar named organization on a state or Indian tribe level. So this would include corporations. This would include LLCs and may include other business entities depending on the state. So in California, it would also include limited partnerships, limited liability partnerships, and general partnerships if they choose to file a certificate of authority with the Secretary of State. Reporting companies also include foreign companies that are registered to do business in any U.S. state or an Indian tribe jurisdiction. And the states are broadly defined to include not only the 50 states, but also the District of Columbia and U.S. territories. So now you're all sitting there going, oh my gosh, like this basically applies to every single company in the US, right? And everyone's probably having a mini panic attack right now. Well, the default rule is it applies to all entities that are formed in the US, but then we have 23 different exemptions. So the rule under the CTA is really every entity has to file unless you fall under one of these 23 exemptions. We're going to go through all 23 in just a second, but generally publicly traded companies, nonprofits, and what they call large operating companies. If you meet the criteria for those exemptions, then you don't have to file at all. You don't even have to file a notice saying you're exempt. You just don't have to submit a filing, and you're going to rely on the exemption if they ever come after you. So here's a list of the 23, but we're going to go through these one by one, and this is going to be a little bit technical because I have the criteria for each exemption I'm going to gloss over a couple of them because, like I said, some of these get a little bit technical. But I'm happy to share this PowerPoint if any of you are interested, if you think one of these exemptions might apply to you and you want to kind of dig a little bit deeper. So the first exemption is the securities reporting issuer. So this is basically publicly traded companies. You either have to issue securities under Section 12 of the Securities and Exchange Act, or you have to file supplementary and periodic information under Section 15D. So we're looking at publicly traded companies with filings with the SEC. Number two are government authorities. So these are entities that are established under an applicable U.S., state, or tribal law, and they exercise government authority on behalf of that state, that Indian tribe, or any political subdivision thereof. So this will be some of your municipalities and such will be exempt. Number three are banks. So if your entity is a bank that falls under one of these three federal laws, then your bank will be exempt. Number four on the same line would be credit unions that's created under the Federal Credit Union Act. Either a federal or a state credit union is exempt from filing. Number five, depository institution holding companies. So there's two different ways that those can fall under the exemption. They're either a bank holding company under the Bank Holding Company Act, or they're a savings and loan holding company under the Homeowners Loan Act. Money transmitter businesses are also exempt if they're either registered with FinCEN or they're a money service business that's registered with FinCEN. Number seven are broker or dealers in securities. So they have to fall under the definition of broker or dealer, and they have to be registered under the Security and Exchange Act with the SEC. Number eight are securities exchange and clearing agencies. So those fall under the definition of the Securities and Exchange Act of 1934. They have to fall under that definition as well as be registered with the SEC. Number nine, other Exchange Act registered entities. So they may not fall under any of the other SEC registered exemptions, but they are registered with the SEC. Investment companies and investment advisors can also be exempt if they fall under the definition under the Investment Company Act or the Investment Advisors Act, and they're registered with the SEC. Venture capital fund advisors, which sounds like might apply to one or two of you. They have to be investment advisors under that or fall under that definition of investment advisor under the Investment Advisors Act. And they've filed a specific form with the SEC. Number 12 should be no surprise. Insurance companies are also exempt as long as they fall under the definition of insurance companies. State licensed insurance producers, so along the same line with insurance companies. These are insurance producers that are authorized by state law and are subject to oversight by the state insurance commissioner. And they also have to have an operating presence at a physical office located in the US. So this is going to require them to physically be here, to physically have an office here, and to have a presence in the US, where the business has to either lease or own a business location, and it has to be their own business location. It can't be something where they're sharing with a bunch of other businesses. They really want to see it set up as a separate, independent, fully functioning business office. Number 14 is the Commodity Exchange Act registered entity. So they have to fall under the definition under the Commodity Exchange Act and also be registered with the Commodity Future Trading Commission. So this covers a couple of different areas. It can cover futures commission merchants, brokers, swap dealers, major swap participants, commodity pool operators, trading advisors, and retail foreign exchange dealers. And I'm sorry if that sounds a little dry, but I have absolutely no idea what any of those things are. That is like way outside my practice area. Public accounting firms. So if you're working for a public CPA or accounting firm and is registered with the SEC under the Sarbanes-Oxley Act, those are exempt from the CTA compliance. Public utilities, this kind of goes back to our municipalities. If it's a regulated public utility under federal law and they provide telecommunications, electrical power, natural gas, water, or sewer services to customers within the US, they will be exempt. Financial market utilities, this is under the Payment Clearing and Settlement Supervision Act. I have no idea what this is, but they have to be designated by the Financial Stability Oversight Council as a financial market utility. Pooled investment vehicles are investment companies under the Investment Company Act, and they have to be either operated or advised by one of these other exempt entities: a bank, a credit union, a broker or securities dealer, investment company or advisor, or a venture capital fund advisor. Okay, so let's get into some of these that are going to more broadly apply to many of our businesses. So number 19 is a tax exempt entity. So we're talking about nonprofits, but they have to fall under Internal Revenue Code 501c, and they have to be exempt from tax under 501a. So this applies to most, but not all nonprofits. So charities, civic leagues, business leagues, recreation clubs, fraternal beneficiary societies. You can also, a nonprofit may also qualify for this exemption if they fall under 501c. 501c. They're exempt from tax, but they lost their tax exemption less than 180 days ago. Now, the tricky thing is that once you hit that 180-day mark, you've then lost your exemption if you haven't regained your tax exempt status, which means you'd have to file again. So that one's a little bit tricky because it's really almost a temporary exemption if your loss in tax exempt status is just a temporary. Political organizations also fall under this if they're exempt from tax status. And if your entity is a trust under the Internal Revenue Code, which generally applies to charitable trusts or split interest trusts. So all those would be then exempt from the CTA, no filing required at all. And along those lines, we also have a separate exemption for entities that assist tax exempt entities. So in order to qualify, this entity has to operate exclusively to provide financial assistance or holding governance rights over a tax exempt entity that qualifies under the section or the number 19 exemption that we just went over. The entity has to be a US person under the Internal Revenue Code, has to be beneficially owned or controlled by one or more US persons that are either citizens or residents. And it has to derive a majority of its funding or revenue from US persons, which again, citizens or residents. So if this entity exists and falls under all that criteria, that's really, it only exists to serve that nonprofit, then that entity would also be exempt from CTA filing. Large operating company. This one probably is going to apply to most businesses, or this is the exemption that most businesses are going to rely on. And I know some of you are going to laugh when you look at these definitions of what they consider a large operating company. But these are, this exemption applies to businesses that have at least 20 full-time employees, and full-time is defined as at least 30 hours a week. Those 20 full-time employees have to be employed in the US, which, as we defined earlier, includes all the states, the District of Columbia, territories, and the Indian territories as well. The business has to have a physical presence in the US. So it has to have a separate physical location where it either owns it or it leases it that's separate from any other business. And that's kind of their primary or their regular business office. They can't just have like an office that they set up that no one ever goes to and no one uses. Like they have to regularly conduct business from that office. And they have to have at least $5 million in gross receipts or sales that's reported on their income tax return. So in order to qualify for this exemption, they look to the last year tax return to look at how much was reported in gross revenue or sales. If the entity is part of an affiliated group of corporations, you can rely on the consolidated return for this $5 million threshold. And there's a list of different tax returns that the 5 million might be reported on: the 1120, the 1120S, which are corporate tax returns, the 1065, which is a partnership tax return, or their applicable tax filing. And then a little nuance, federal income tax principles require the gross receipts or sales from sources outside the US to be excluded. Then the gross receipt sales within the US need to still meet that $5 million threshold. So for the quote unquote large operating company exemption, we're really looking at, you need to have at least $5 million in revenue that was actually reported on your tax return, and at least 20 full-time employees and a physical office presence in the US. So there's probably a bunch of you on the line right now that like have a sigh of relief, like, oh, thank God, like that's my business. I don't have to deal with this at all. So that's our large operating company exemption, and that's used for a lot of businesses so that they don't have to file. Number 22 is a subsidiary of certain exempt entities. I have the list here. It's most, but not all of the exemptions we just went through. If they have a subsidiary where the ownership is either controlled, so more than 50%, or wholly owned, which is 100% ownership by any of these other exempt entities, then its subsidiary is likewise also exempt. And then the last exemption are inactive entities. Now, to qualify for this, your entity had to have been in existence on or before January 1 of 2020. It is not currently engaged in active business. It is not owned by a foreign person, either directly or indirectly, wholly or partially. So a foreign person is someone who is not a citizen or a resident of the US, is not a domestic partnership, corporation, or other estates or trusts. That entity cannot have any change of ownership in the prior 12 months, and the entity cannot have sent or received any funds greater than $1,000 in the prior 12 months, and the entity does not otherwise hold any assets in the US or abroad. So this is really looking for entities that have basically gone defunct and for some reason haven't been dissolved and are just kind of sitting out there. Now, I had a question before we got started I wanted to address because it's related to this, which is, well, what if you have an entity that dissolves before the end of this year? You know, do they still have to file? And the answer is, if they don't fall under this, if they don't meet all the criteria of this inactive entity status, the FinCEN has released an opinion that says, yes, they still have to file. So if your business or the business that you're dealing with was in business, doesn't fall under this inactive entity criteria, and dissolved, even if they dissolved January 2nd of this year, they still have to file that BOI report before the end of this year. Now, the good news is once you file that initial report, you're done because it's dissolved. You'll never have to do it again. But the entities dissolving in this year still have to file unless they can meet all this criteria, which is kind of interesting because if you have a business out here that's more or less defunct, but then it kind of picks up activity, maybe it's kind of sitting out there as a holding company, hasn't really done anything, but then all of a sudden you get a distribution for $2,500. Okay, well, now you're no longer an inactive entity and you have to file again. So you have to be careful with some of these exemptions because they kind of ebb and flow, and you may lose the exemption, which would then trigger a filing. Okay, so now that we've gone through the exemptions and you're sitting here going, all right, well, my business didn't fall under any of those. I guess we need to file. So what information are we looking at to file? So the big thing is the beneficial owners. And there's other basic information that has to be filed about the business, its name, the state that it was formed in, its business address, its tax ID number, real basic stuff gets reported about the business itself. But what everyone's worried about is the personal information. So you have to report on every beneficial owner for the business. And a beneficial owner is either a person who either directly or indirectly exercises substantial control over the company, or owns or controls at least 25% of the owner interest in the company. Now, with some smaller businesses, you may have a person that falls under both. Maybe someone's a majority shareholder and they're also the president. The good news is that the form doesn't distinguish between someone who's decision making versus the 25% ownership. So you don't even have to check a box for it. They all just fall under that general category of beneficial owner. So you only have to report their information once. So if you have a business where you have, two people that are owners 50-50 and they're, president, secretary, CFO, and all the directors, you just report on those two people and you just report each of their information once on the form. So what is substantial control in terms of decision making? Well, the laws defined it to include senior officers, persons that have the authority to appoint or remove certain officers, or the majority of directors, which would by definition be majority shareholders, individuals in the business that are important decision makers, and individuals that have any other form of substantial control over the business, the actual business, its finances, or its structure. So these are pretty broad categories. So generally, we're looking at people with titles like president, CEO, COO, CFO, general counsel, or people with similar titles. People that have authority over appointments, which is the appointing or removing senior officers or a majority of the board. That obviously would include people that are board members, the board of directors themselves. If there's any sort of special directors or tiebreaker directors that are built into the entity structure, they would fall under that. And we have a note here for cumulative voting. In California, certain shareholders are allowed to accumulate their votes when electing directors in order to control at least one board position. So someone may not have, depending on how the corporation is set up and how many directors you're electing, someone may own less than 25% of the ownership, but may be able to accumulate their votes enough to control at least one board seat, in which case they could then fall under this definition because they would have the ability to appoint at least one director, and then would have to be reported as well. Okay, so going back to, or staying on the substantial control, next, important decision makers. So this is defined as someone who directs, determines, or has a substantial influence over important decisions in the business, under these three categories. So business decisions, which would be decision making on the nature of the business, its geographic focus, the ability to enter or terminate contracts. So if you have someone that might even be a lower level, but they have the authority to enter into contracts on behalf of the company, they would have to be reported. Financial decision makers. So someone who has decision-making authority on the transfer of assets, major expenditures, or compensation for the officers. So if you have like a separate compensation committee within your organization, they may fall under this financial decision-making definition and would have to be reported. Structural decisions with the company, who has the ability to decide on dissolution, merger, and amendment of governing documents. These generally are going to fall to board of directors and shareholder decisions, but some entities are set up a little bit differently. So you have to look at your organizational documents to see, you know, do we have, you know, maybe you have some preferred shares, people, shareholders with preferential rights, and they may have a say on, you know, any merger or any potential dissolution, or they may have veto rights on, you know, amendment of certain documents. You know, even if they don't have that, meet that 25% ownership threshold, they may qualify under the structural decision-making criteria and then would have to be reported. And then, of course, we have the catch-all, which is any individual that has any form of substantial control over the business. So when you're looking at your business, you really have to, you know, kind of take a look at who are the decision makers in the business, who has the ability to, you know, to sign off on things with or without other people's consent, and really look at how your business is set up and structured, because there may be multiple people within your business that don't qualify as maybe a senior officer or director, but that could fall under this catch-all that would then have to be reported. So switching over from the kind of decision making to the ownership, we have a couple of different criteria, and some of it is, you know, fairly self-explanatory, right? You own 25% of the company. But some companies are set up a little bit more complex. So the law defines it as individuals who own, control, or have non-binding privilege to buy or sell equity, stock, voting rights, capital, profit interests, convertible instruments, and options of 25% or more of a company. And in calculating that 25% threshold, you have to assume that any options or convertible notes that are out there have been exercised. So these people may not even be owners yet. They may just have an option to purchase in the future, but you have to include them, assuming that they had exercised in the ownership calculation. So if you have someone sitting out there with large amounts of convertible notes or stock options, they may have to be reported even if they're not currently an owner or don't currently meet that 25% threshold. And you'll notice that we've been talking here about individuals. The Corporate Transparency Act essentially disregards any entity ownership of a reporting company. So if you have a corporation that's owned by two other corporations, you don't get off the hook because you have a corporation as a shareholder. Instead, you have to look down to the underlying ownership of those shareholder corporations to see who owns that. And you basically have to keep going down level by level until you reach individual ownership. And then you kind of have to do the math and go back up and say, okay, does that individual, once we get through however many layers of entities are they own or are owned up to that shareholder level, do they actually have a 25% ownership interest? So an individual who has stock in multiple entities may still collectively own 25%. So you may have, in my example, your reporting company that's owned by two corporations, and your two corporations may have multiple shareholders. But if one shareholder owns in both of those corporations and together owns at least 25% of the reporting company, that person has to be reported, even though individually they may have less than 25% in each company. For trust ownerships, that's a little bit nuanced as well. If your trust is an owner of your reporting company, you would need to report on the trustee or someone with similar authority who has the ability to dispose of trust assets, the grantor or settler of the trust, if they still have the right to revoke the trust or withdraw trust assets, and any beneficiary of the trust who is the sole recipient of the trust income, or who has the right to demand distribution from or withdraw trust assets. So if you have any shareholder, or not shareholders, but owners of the business that that are owned by a trust, unfortunately, this probably requires an analysis of the trust document itself to figure out who's the trustee, so the trustees definitely have to be reported no matter what. And then you have to look at the grantor settlor. Are they still alive, and do they have the right to revoke the trust or withdraw the trust assets? And then who's the beneficiary of the trust? And are they the sole recipient of the trust income at this point? Or do they have the right to demand the distribution or withdraw the trust assets? So any trust shareholders or owners of entities really is going to require either an analysis of these three criteria, or, if you're working in the business yourself and obviously aren't comfortable making that sort of analysis, you may need an opinion of the trust attorney on who qualifies under these criteria at the present time for that trust. So on the figuring out who owns the 25%, as I mentioned earlier, the default corporate calculation is pretty straightforward, right? Number of shares owned divided by number of shares issued. That's a little bit nuanced if you have the stock options or convertible notes out there, because then you have to add that into the total shares issued. If you have different classes or series of ownership with different voting rights, you have to calculate, there's two different calculations that you have to run it through, and you use the higher percentage of the two calculations. And so I have those two calculations set out here. First one is to take the total voting power of all classes that the individual owns and divide that by the total voting power of all classes entitled to vote. And that'll give you a percentage. And then you do the second calculation, which is the total combined value of their ownership, and divide it by the total outstanding value of all classes of ownership, which is a little bit different. And it's that one's an interesting one because especially with privately held companies, right, what we're dealing with here, determining what the value of someone's ownership is and the value of the company. How do you do that? I mean, is this going to require you to get a business valuation in order to justify that calculation? I don't know. That's obviously expensive and takes time. But that may be needed if you're going to be relying on that calculation to exclude someone, in case FinCEN ever comes back and challenges your filing. If your company is a partnership or it's taxed as a partnership, there's a separate calculation, which is their capital and their profit interest divided by the total outstanding capital and profit interest. And then your catch-all is, 25% or more of any class or type of ownership. So that catch-all is a little interesting if you have multiple classes, because that certainly implies that even if you're not a 25% owner of the whole company, if you're at least 25% owner of your particular class, you may still have to be reported. So this, what happens if there are indirect owners, which is what I started talking about earlier. So this is where you have entities that are the shareholders. So you have to keep going down to the level of entity to find the individual to see if they end up with that 25% ownership of the reporting company. So simple example is you have a reporting company that's owned by two other companies 50-50. So you have 50-50 shareholders or owners. Then you have to look at the underlying ownership of each company and say, does anyone own at least 50% of that underlying company? Because if they own 50% of that company, then they own at least 25% of your reporting company. Plus, in addition to this, you still have to report any decision makers in addition to the shareholders. So it may be possible that when you do an analysis, you have so many owners, or you might have entity owners, and as you dig down to the different individual levels, that no one actually owns at least 25%. Maybe everyone's, 20% or less. Well, that means you don't have to report any of those owners, but you still have to file a BOI report because you still have to report all decision makers in the business. So you're not going to, you know, there's no get out of jail free card here. If you have everyone's less than 25% owner, because you still have to report decision makers, your board of directors, your president, your senior officers, you know, and anyone that has substantial decision-making authority in the business. And then just a note here that when we're looking for individual owners, that includes both US citizens and residents, as well as foreign individuals. If you do have individuals who are foreigners, either directly or indirectly via entity ownership, you have to report the foreign individuals, and they have to be reported using their foreign passport as their identifying document. We'll get to the identifying documents later on, but that's important because that's the only document that FinCEN will accept for foreign individuals is a foreign passport. So if you have any foreign owners and they don't have a passport, they need to get one. Exceptions to the definition of beneficial owner. So they do have an exception for minors that own the stock, nominees, intermediaries, custodians, or agents don't have to be reported, but you do have to report on the actual owner that they're representing. You don't have to report employees who exercise substantial control solely because they're an employee, but they're not a senior officer. So if you have employees that have some decision-making authority, but their only role in the business is as an employee and they don't fall under that senior officer category, they do not need to be reported. You don't have to report any individuals with a future interest in a reporting company, such as through inheritance. So that goes back to that trust analysis. So the fact that they're respectively that they're maybe a contingent beneficiary under the trust, but they're not a current beneficiary, they wouldn't need to be reported. And creditors also don't need to be reported. So there's like some exceptions under California law where you could get like charging orders against LLCs by creditors. So they wouldn't be reported, even though they may still have an ownership interest in the entity. So what are we reporting? So now we've gone through, okay, our company, is a reporting company. We file with the Secretary of State. We don't fall under any of the 23 exemptions. And now we figured out, who our beneficial owners are, who our decision makers are. So what do I need to actually report to FinCEN? So the first thing you have to report is the basic information about the reporting company itself, which I mentioned earlier. So full legal name, any trade names that the company operates. So if you have what's known as a DBA or a fictitious business name, those would also be reported on the form. Their current US address, the jurisdiction of formation, so what state you filed your organizational documents in, your taxpayer ID number or EIN. So all your businesses should have an EIN already. I know that there's some attorneys out there that will file or prepare single member LLCs and just use their social security number. You probably don't want to do that. It's probably not a good idea to begin with. But you'll want to get each of those entities an EIN in order to file for this. So that's the basic information on the company itself that gets reported. And then for each beneficial owner, which again is the 25% or more owner and the decision makers, for each of those people, you have to report their full legal name, their date of birth, their current residential address. So don't use a business address. They want their residential address. And then you need to provide a identifying document and the document number, which is generally you're looking at US passport, your state driver's license, or your state or tribal ID card, along with whatever that number is. So your passport number, your driver's license number will get reported. If you're, and as I mentioned earlier, if you're not a US resident, you can use a foreign passport, but there is no mechanism for foreign owners to use a foreign driver's license. So if you have any foreign owners, they have to have a passport. And then there's a note here that this information also gets reported for company applicants. And I'm going to talk about company applicants separately. Oh, look at right now. That was a great segue. So company applicants also have to report their information. Company applicants are individuals who basically participate in the formation of the entity. Now, this only applies to new entities that are filed 2024 or later. If you have a business that was formed December 31, 2023 or earlier, so it's considered an existing reporting company, and you don't have to worry about a company applicant. When you go into the form and you get to the company applicant page, there's a little box to check that says existing reporting company. And then it'll white out all the company applicant information. You can just hit next, go to the next page. You can skip over it. But for those entities that are formed this year, next year, or beyond, you do have to report on company applicants. So these are direct filers. So they file the document that created or registered the reporting company. And this is someone who either physically filed it or electronically submitted the document for filing. And any individual who directs or controls the filing, but didn't necessarily file it. So in my world, we're generally talking about the attorney that prepared the articles and the paralegal that submitted it to the state for filing. But it could also include if you use a filing agency, the person's information on the agency who actually submitted the document for you for filing. If any of you file for your businesses, then your information would be reported. Accountants, individuals within the business. So if you're self-filing for your own business, you would then be reported as the company applicant. And the company applicant reports the same information as beneficial owners. So full legal name, residential address, date of birth, and then an identifying document, passport, driver's license, state ID, all that has to get submitted to FinCEN for the people who participate in the formation of the organizational documents for the business. The good news with the company applicant, unlike beneficial owners, is that there's no need to update the information on company applicants. So if your address changes or whatever, if you used a filing agency, like they don't have to contact you every single time, their home address changes. You don't have to update that information. Which brings us to FinCEN identifiers. So for people that file frequently or that are involved in multiple entities, you can get a FinCEN identifier. And what that is, it's a unique number that gets assigned to you after you provide them all of your required information: name, date of birth, residential address, and identifying document. And it'll give you a FinCEN identifier number. And so when you go to file, then instead of having to fill all that information out, you just put in your FinCEN number. So I have one because I do a lot of filings for my clients. And so I'm often the company applicant. So I just, instead on my clients' forms, I just put in my FinCEN number. And when we print out the transcript, it doesn't even have all my personal information that my clients have. But if you're involved in multiple entities, or you have clients that, are going to be, that own, 10, 20, 30 different LLCs, you can get them, or they can get themselves, a FinCEN identifier on the FinCEN website. And then they'll just have that number, and then you can just plug in that number every time you're identifying them as a beneficial owner, which you can use, if they're a 25% or more shareholder or owner, or if they're a decision maker, they can just use this FinCEN identifier instead of submitting their personal information every single time. So some special reporting rules. So if your business, if you have a for-profit business, and it's owned by an entity that falls under one of the 23 exemptions, then you don't need to report any information about the beneficial owner. but you would still need to report on all the decision makers. If you have a minor child who is an owner, you would report the information about the child's parent, and there's a little box when you're doing beneficial owners that says this is for a minor. You would check that box and then you would just fill in the parent's information. There's also a special rule for foreign pooled investment vehicles. If the company was formed under the laws of a foreign country and would have been a reporting company, if not for exemption 18, then you just have to report the individual that has the greatest authority over strategic management. So updating your BOI report. So there's an obligation to update your report. First, if you discover there's any incorrect information, you have to file a updated corrected report within 30 days of discovery. So that would, if when you go through the whole BOI report process, at the end, you'll get a confirmation page. I suggest you save it or print it out. And then it has a link to a transcript, and you should also save that. And the transcript has basically all the information you input into the form. So you should save that, and you can look through it. And if you later find out there was like any typos, or, you switch the numbers on someone's birthday, you do have a duty to go in and file an updated report within 30 days of discovery of the error. You also have to file an updated report whenever there's a change to any information about your reporting company. So if they change their legal name, if they get a new DBA, if it moves and has a new address, if for some reason you get a new EIN, which shouldn't really happen, you would have to file an updated report. And when you go into the filing, the first box is what type of report you're filing. Is mostly, for now, you're going to do initial report, but there are options for an update or change in information. On your individuals that you're reporting, if they've had any life events, such as a legal name change, if they've moved, or their government ID number has changed, then those would require an updated reporting. If you have any change of ownership within that 25% threshold, then you would have to file an updated report. And if your change in ownership is due to someone's death, your 30-day period to report the change in ownership starts once the estate is settled. So that obviously gives you time, because obviously if someone's estate is probated, the probate, can take a couple of years. So your triggering filing date is once your estate is settled. If you have any change in management, if you have new directors, new senior officers, that would require an updated BOI report. Or if your exception no longer applies to your company, then you have to then file a report, which we talked about earlier. Losing your nonprofit status for more than 180 days, well, then you now have to report. Or if you no longer fall under that inactive entity criteria, then you would have to file a BOI report. Once your minor shareholders turn 18, that would require an updated report, because they are now the owner instead of the parent that's being reported. If you have any sort of inheritance or distribution on death or gifts, again, for this 25% or more threshold, those would need to be reported. And what else? And then if you didn't qualify for an exemption before, but you now qualify, so maybe you missed that $5 million threshold on your last tax return, but then you file the next year's tax returns and you've met that $5 million threshold for the large operating a company exemption, you file a new report and there's a box to check that says we're now exempt. And that just notifies the BOI that you now fall under that exemption. And then you don't have to file any further updates as long as you maintain that exemption. And as I mentioned, all of these require that updated report within 30 days. So, well, but if I don't report, so there's a safe harbor that gives you 90 days to correct a report from the deadline. So you technically have 30, you have your end of year to file your current reports. And so you have basically a 90-day grace period. And for updates, you have 30 days to file, but then you have a 90-day grace period after that. But if you still don't report or you don't file the update and FinCEN decides that it's a willful failure to file, they can impose civil or criminal penalties. And right now with inflation, the penalty is $591 per day for failure to file or update. And they can go after criminal penalties of up to 2 years in prison and a $10,000 fine. So they have said that this will apply to senior officers. So the corporate or LLC entity isn't going to shield you if you're one of the top dogs in the company and you make a willful or intentional decision not to file or not to update. Or this also includes filing a false or fraudulent document, such as falsifying the identification document, that can get you in trouble as well. Now, this is all pretty new, like the filing requirements just started this year, and we haven't even hit, we haven't gotten to that 90-day grace period for the initial filings for existing companies. So no one really knows what FinCEN's going to do with this, how much they're going to crack down. I would hope that this is really going after the bad actors, the money launderers, the people financing terrorism that's trying to avoid this, and not for our everyday small businesses that don't know any better. But you guys are here, and now you know that you have to file. So some kind of pending question, unknown issues that haven't really been addressed, and things are still kind of up in the air. So there's no reporting requirement when you dissolve an entity, which is really strange. There's no box to check to say this entity has now dissolved. So you just stop updating, presumably, and they're not going to care. But that one's kind of up in the air, and I would expect that at some point they're probably going to have a required filing to submit when your company shuts down and dissolves, so they stop tracking it. The definition of substantial control, as we went over earlier, is pretty loosey-goosey still. And there's a lot of wiggle room each way, so we don't really know what FinCEN's going to do when they start trying to enforce these things. What if your foreign owner doesn't have a foreign passport? Since you can't use a foreign driver's license, they haven't given us a solution on that. So right now the recommendation is to go make your foreign owners get foreign passports. What happens if, you have a FinCEN identifier and you stop filing? Do you have to keep updating your information with them forever? So FinCEN said they're looking into this, and we don't have an answer on that. Who's going to be able to access these filings in the future? It says that they're going to give us further guidance, but at this point, we don't know who's going to have access to it. We have that list we went through at the beginning, and it's very possible they may broaden exposure, but at this time, as I mentioned, it's not publicly available. More confusion coming out of the Alabama case, which we're going to talk about right now. So the penalties apply to individuals, and apparently not to the entities themselves. So I know the big question is, well, is this law even legal? Is this really even enforceable? And the answer as of right now is yes, unless you're a member of the National Small Business Administration. So there's been several lawsuits that have been filed challenging the Corporate Transparency Act. The only one that's really made any ground is a case out of Alabama, the National Small Business United versus Yellen. And they basically filed claiming that the law exceeds Congress's authority and violates the First, Fourth, Fifth, Ninth, and 10th Amendments. And the lower court, the district court in that case, ruled that the Corporate Transparency Act is unconstitutional because it exceeds Congress's powers, since corporations are creatures of state law and Congress doesn't have the power to extend to internal affairs of corporations, and that the CTA isn't focused on commerce, so it doesn't invoke the Interstate Commerce Clause. But the district court in that case issued an injunction that only applies to the National Small Business Association and its dues paying members. So unless you're a member of that organization, you still have to comply with the law as of today. That has been appealed. And I checked yesterday afternoon, they had oral arguments in that case in the 11th Circuit Appellate Court on Friday, but no decision's been rendered. There's a couple of other cases that are pending in Michigan. I saw Massachusetts, Texas, and Maine, but so far there's been no substantive decisions in those other cases. So right now, as it stands, the only place where a decision's been made has been the Alabama case, and only to those members of the National Small Business Administration. Everyone else is not subject to that injunction and still has to comply with the law. So a couple of best practices. This is more for those of you who are looking to file on behalf of clients. Obviously, if you're going to be filing like I do, get a FinCEN identifier. For those of you that advise clients, I would, we recommend notifying the client of the filing and update requirements in writing, or you need to exclude this from your scope of work so that the clients can't come back and say you should have taken care of this for them. For those attorneys on the line, if you're preparing entity formation documents, you should consider updating those documents to include obligations to report updates. So like if you have LLCs, LLC operating agreements, that should be a new provision in your operating agreement to bind the members to update you when their legal name changes, their address changes, etc. Because once you're on notice that this happens, you're a senior reporting officer for your company, you have an obligation to file an update. And what do you do if these people don't cooperate with you? So it's really important within your organizational documents to put in at least a duty on behalf of the other owners to cooperate with that information. For new entities, make sure that your new entities that you're working with are aware of this requirement, because the filing time period is about to get short. It's about, in 2025, it's going to go to 30 days for all the new entity formations. This is a link to the small entity compliance guide that FinCEN put up. Has a lot of great information, and it's very user friendly. Where I go in there and I just do word searches when I have questions. Very easy to find, and that was a lot. I know that was that was probably information overflow.